Coming up today, tech shares lead the market higher. Tesla closes at an all-time high. Same with Alphabet. What Tom Lee sees next year. A look at inflation data. Janet Yellen says she's sorry. And why the bears get all the attention, but the bulls make the money. It's going to be a good one, guys. Let's go. And welcome back, guys. The market having a little bit of a bump up here today. S&P 500 up 77 basis points, but it was mega cap tech once again leading the charge as it has been over the past 2 weeks now. As a group up 2.7% today to all-time highs. And leading the charge, none other than Tesla itself. Brand new all-time highs, closing at $424 a share. And just going out to a monthly chart, we can see that here. Just having taken out those all-time highs from November 2021, what a rip it's had these past few months. Unbelievable how hard Tesla can run, given the size of the company. It wasn't even 2 months ago I was adding to my long-term position at $219 a share, and here we are, we've almost doubled in less than 2 months. That's why I always say don't short Tesla. When it runs, it can run hard. And once again, the market has flipped its narrative. No doubt a lot of people are FOMO now, going to be chasing it, because back here, no one really wanted it after the robo-taxi event. Amazing how many financial influencers out there. Screaming bears, saying be careful, stay out, it's going to go back down. But once again, they've been proven wrong, and the bulls have been proven right. So congrats if you've stuck with Tesla. This is a good day for us bulls, as we're now trading in blue sky territory. And this was on the back of strong sales in China. They sold 73,000 EVs just last month alone. And the street and every analyst is jumping back on board as well. Nothing changes people's minds like price. And the reason why I was adding to my long-term position after the robo-taxi event, as it was easy for me to see there was going to be a lot of pent-up excitement around their upcoming products. Robo-taxi, Optimus, the cheap EV, add on top of all that, must help Trump get back in the White House. So he went from having a huge political risk to now having a huge political tailwind, helping to run the new government itself. And so all the stars have aligned for Tesla and Elon Musk of late. And they've just done so well in the face of a high rate environment, cheap EVs coming out of China, and even the loss of those regulatory credits. Just had the stock sell off for a day before the dip was bought, as that's more likely to hurt Tesla competitors than Tesla itself. We just heard yesterday, General Motors said it will scale back its ambitions for a robo-taxi network, which was probably a smart move. Be hard to see them really compete with Tesla and Uber in the future big industry of robo-taxis. And so with that move today, along with SpaceX's latest valuation, makes Elon Musk the first person ever to surpass a $400 billion net worth. Kind of mind-blowing. He's worth almost $500 billion and will most likely be the world's first trillionaire. And unlike most billionaires, he doesn't engage in a lot of personal indulgence. Doesn't own a dozen cars, mansions, yachts. Instead, he still works harder than probably 99% of all other people out there. But believe it or not, there's still old members of the Tesla community still sounding off about Tesla and Elon. One of the most famous, Jim Chanos, known for his years-long attack on Tesla, shorting the stock, lost a ton of money, had to close down his fund, and he'd been running for decades. And still to this day, he's trying to attack Elon and the new Department of Government Efficiency. And it's kind of sad to see a 70-year-old man, successful, spending his days on X typing stuff like this, laugh out loud, okay, down in Elon's boring company, among many other things. In fact, just doing a search for Jim Chanos, and every time he's mentioned the Tesla stock ticker symbol, not even just the word Tesla or Elon, shows his feed full of attacks on Tesla and Elon, just constantly. I'm not sure if he's still short the stock or just got a personal vendetta, but it seems like Elon Musk lives rent-free in Jim Chanos' head, along with many others in the Tesla bear community who just can't seem to get over it. It's kind of like those with TDS. It's like they live in this little hate bubble. They spend so much time hating on someone. But this is what's helped to drive Tesla stock price to begin with. So many people doubting it, so many shorts just created monster short squeezes. And Elon's just picked them off one by one, and it's probably all worked to his advantage, along with us long-term bulls as well. But it's not just Tesla doing well today. Alphabet making a quick comeback of late as well, just like Tesla kind of been left behind with the other mega cap techs for much of this year, kind of stumbling a bit. Then it just came out a few days ago with their new Willow chip computer, making a breakthrough in the computing power, leaps and bounds on what was previously possible. And like I've been saying of late, since it's had the best valuation out of all the mega cap tech, it was due a bit of comeback, which we've been seeing these last 2 days. Monster volume coming into the stock, breaking out above this key resistance zone, $195 a share, just going out to a monthly chart, brand new all-time high. We also got a little bit of a bounce back at NVDA today, and the others like Meta and Amazon also trading up to highs too. So the market's definitely come back to mega cap tech these last few weeks, after we've seen a bit of a pause and pullback in the small caps. Except for one group, quantum computing. That ties in with what Alphabet said with Willow. This seems to be the hottest part of the market right now. A lot of these small quantum stocks ripping like crazy this last month or two. You can see that in this chart here. Rigetti, D-Wave Quantum, IonQ, and just looking at the entire quantum ETF, is a little stretched here, and some of them have already started pulling back today, like IonQ and D-Wave Quantum as well, putting in a bit of significant reversal bar there, maybe drew a bit of a breather. But just getting back to the market, we've got one of the biggest bulls of the last 2 years who's probably forecast the market better than anyone. Says he sees the S&P soaring 16% early next year before a sharp sell-off in the second half. Bullish factors include support from a dovish Fed and business-friendly policies under Trump, yet potential GDP impacts from tariffs and Dodge-related spending cuts are risks. And I think that's an important one as well. If the government does slash its spending a lot, that could actually be deflationary. And that could actually overwhelm the inflationary impacts from tariffs. Because I'd say the biggest driver of inflation these last couple of years has been record government spending, which I'll get a bit more into that in a minute. However, Tom's given us a neat little drawing where he sees the market going next year. Up to 7,000 by mid-25 before we get a bit of weak seasonality, Q3, taking us down to about 5,800 before we pop back up to 6,600, finishing about 10% higher. And I can see that scenario playing out as well. However, it's very rare the market will follow the exact pattern someone's drawn out in advance. So we may get something completely different than this. And one thing that does concern me a little is Wall Street analysts are getting really bullish on next year. After they came in way lower the last couple of years, they may be overcompensating in the other direction now. Some like Oppenheimer got their S&P 500 target 7,100 by the end of next year, 17% upside from current levels. That would be a really good string of yearly returns for the S&P since we've just come in above 20% this year and last. Although it certainly is possible, we do have a lot of momentum in the economy and the market. We just don't know exactly how tariffs are going to play out, not to mention government spending cuts as well. What's been under a lot of pressure of late, one of the weakest group of stocks in the market, creating a lot of dispersion in the market, healthcare stocks. Been trading weak going into the election and coming after it, especially United Healthcare. After the killing of their insurance CEO has raised a lot of scrutiny and debate, in which it looks like the killer's intentions may be actually playing out as intended. And in fact, looking across social media and research, there's actually a lot of Americans, especially younger Americans, coming out in support of the killer. A lot of merchandise around him being sold. And we've got healthcare companies removing photos of their executive from their About Us pages on their websites out of fear they too may also be targeted, because that's the state of the US healthcare industry. Insurance executives have to stay hidden from public, otherwise one of their customers may exact revenge on them. As it said, the killer fell off the deep end after he had a back operation. And here's the article talking about it. Some people making this guy out to be a hero. Again, very unfortunate, but telling of how many Americans feel about the healthcare industry. And it looks like investors are starting to feel the same way. United Healthcare Group, a long-standing blue chip in the Dow Jones Industrial Index, falling another 5.6% today on heavy volume. And that was the day of the killing up here. Stock actually rose on the day for some reason. Then the next day it started going viral that United Health knocks back almost a third of all claim. And in short order, the blue chip stock has already fell 13%, causing another weak day for the entire healthcare sector. And like I said, been trading a lot different from the rest of the market. And we can see that in the sector trends table. In fact, it's only energy and healthcare, only two sectors underneath all their moving averages, whilst we've got the NASDAQ above all of its ones. And just moving on today, we've got inflation coming in line as forecast, core increasing 3.3% year over year, with monthly 0.3%. And like I said, that doesn't seem to upset the market. 3 is the new 2. However, just looking at the 3-month and 6-month annualized rate of the CPI index, excluding food and energy, is starting to curl back up. May indeed have found a little bit of a floor here. And just looking at the 12-month price change in a bunch of different categories, auto insurance still at the front, airfare, rent, education, housing, earnings, hotel rooms, restaurant meals, medical care, and where we're seeing deflation, gas, rental cars, electronics, toys, used vehicles, furniture, mostly discretionary stuff. Well, it's mostly the necessities that are still inflating. And so tariffs should affect more of the stuff down the bottom half of this graph here. Stuff coming from offshore, as there's not tariffs on anything domestically made or served up. Like I said, a lot of that inflation is still hanging around thanks to record government spending this last couple of years. Just heard today the budget deficit blown out last month, pushing the fiscal 2025 shortfall 64% higher than a year ago. Just last month, the government spent $366 billion more than what they took in. That's a mind-blowing number and simply unsustainable. And there's a look at a long-term chart of the United States federal government budget. And so we can see there in the GFC, budget deficit got to almost 10% of GDP. Then it kind of recovered and actually got to pretty good levels, 2016, 17, 18, going into 19, 3-4%, which was actually looking pretty good compared to the last 30, 40 years. Then, of course, we got COVID, which the government just completely blew out their spending and has continued to spend so much money since COVID. 2021, 12% of GDP. 22, 5%. Here we are now, 6.2% deficit to GDP. So in my opinion, the government overcompensated a lot for COVID. They probably could have done nothing and it would have been fine. We're all sitting at home for a few months. We're still buying stuff online. Instead, they're all pumping the markets in our bank accounts full of cash, not to mention blowing out the size of their own government along with their own spending as well. But don't worry, because one of the most influential people people over all that spending. Janet Yellen says she's sorry more progress wasn't made on the deficit. Said she's concerned about the nation's fiscal sustainability, and she's sorry that more progress wasn't achieved during the Biden administration. She believes the deficit needs to be brought down, especially now we're in an environment of higher interest rates. And so the fact is, US debt rose by $8.2 trillion while Yellen was at the Fed, then rose by another $8.5 trillion while she's been Treasury Secretary. That's almost $17 trillion, which is almost half of the US government's outstanding debt of $36 trillion. In other words, Janet Yellen has been a part of US debt almost doubling since she first came in. And this is the same Janet Yellen who, in between government jobs, got paid almost $1 million from Citadel in, quote, speaking fees, unquote. For those of you who don't know, speaking fees in finance are pretty much a bribe because no one deserves to be paid $300,000 to speak for half an hour, especially from one of Wall Street's biggest hedge funds who were paying her off before and after the GameStop saga. And after getting paid off from Citadel, she got back into government and she would not recuse herself from advising Joe Biden on the ongoing hedge fund mania, in which the government gave a controversial conclusion, more scrutiny on the Reddit meme traders. Then on Citadel and Robinhood, who are accused of colluding to literally turn off the buy button on those stocks at the height of the short squeeze. Citadel was financing another hedge fund that was massively short the stock, losing a lot of money. They had a lot of tail risk. Ken Griffin went on camera in front of Congress and said Citadel was not communicating with Robinhood. They had no idea of each other's actions. How it was later found out there were indeed internal messages on that day between Vlad, the CEO of Robinhood, and wanting to speak with Ken Griffin. And of course, they would have done it offline or through an encrypted app, so we'll never know. But it's pretty obvious what happened. Anyway, it wasn't just Citadel that paid off Janet Yellen. Basically, the whole street did, which is kind of unbelievable that this is not considered a conflict of interest. If you want a clean democracy, you got to get rid of this sort of crap. This is basically corruption. Top officials that set policy and scrutinize the system and advise the president shouldn't be getting paid more than $7 million just to make a few talks to Wall Street banks. Because at the end of the day, were they really just paying to hear her ramble on for half an hour, or were they buying something else? And so I'm not sure who's more corrupt, Janet Yellen or Nancy Pelosi. Her and her husband accumulated over $250 million during her career as a politician. Just so happens to beat the market most years and by a wide margin. Just like she is this year, doing very well, up 36%, but doing even better is Cramer. But not by following Cramer, but by doing the exact opposite of what he says. The inverse Cramer index is up 38% this year. But there is hope, just like we've seen in Argentina. You get the right leader in there who cleans up the government, gets rid of corruption, gets rid of the excesses, and good things can happen in a short time. We just heard that with Argentina, ending their deficit for the first time in 123 years. And just quoting Javier Milei today, the deficit was the root of all our evils. Without it, there's no debt, no emission, no inflation. Today we have sustained fiscal surplus free of default for the first time in 123 years. This historic achievement came from the greatest adjustment in history and reducing monetary emission to zero. A year ago, a degenerate printed 13% of GDP to win an election, fueling inflation. Today, monetary emission is a thing of the past. And it's true, he's got the best performing stock market this year out of the entire world. He's brought inflation way down, and that's because he's done a dramatic and material shake-up of the government, not just smoothing the edges and giving us some sales talk. He's actually taken the butcher's knife to the size of the government and spending. It just goes to show that's really the government that drives inflation. And just looking at Argentina, once again, the best performing stock market in the world today, up over 4%. We're just getting news. Argentina and the States looking at doing a free trade agreement. Guess it helps being good friends with Trump and Elon Musk. And so Argentina has well and truly come back from the dark, murky depths of global capital markets, now kind of in the limelight, and could very well have a good 2025 as well. But as talking of tariffs, we just heard from Bank of Canada doing a pretty sizable cut, 50 basis points. Getting their rate down pretty low, 325 now. Maybe trying to front run potential 25% tariffs, which I'd say is a pretty good move, just like we've seen China make some moves ahead of likely tariffs. And all in all, developed nations are still well and truly in an easing cycle. And if all these central banks get real dovish in preparing for a nasty tariffs and they don't really materialize to be that bad, then we're going to find ourselves in a pretty good setup. Low rates with good growth should be a tailwind for risk assets. Just moving on commodities, we've got Goldman Sachs saying there's 3 factors that will drive the price of gold 11% higher next year. The first factor they see driving gold higher is the Federal Reserve policy. They predict significantly lower rates next year, being one of the most dovish forecasters amongst Wall Street banks. They think we'll get down to 325, and that's a tailwind for gold. Second, they think a stronger dollar will boost the gold buying spree led by central bank. They think foreign banks will add 30 tons of gold per month through 2025, which again is structurally higher ever since Russia was hit with their sanctions and their dollar reserves frozen around the world. Causing a bit of panic and anxiety amongst other foreign central banks also exposed to that sanction risk. And that's going to be an interesting thing in markets over the coming years. The US dollar reserve BRICS currency and payment system, gold, Bitcoin, how all this plays out could go a lot of different directions. Third, gold and the dollar have shared a reason for rising in 25. Though gold typically softens when the dollar rises, that's usually because the greenback is reflecting economic strength. But this time around, the dollar is rising on international issues and not from expectations for higher interest rates. I think that's true as well. The dollar's been rising on perceived continued strength in the States, along with tariffs hurting the rest of the world more than the state. And there's a look at the dollar seeming to hold on to this uptrend, bouncing off the 50-day, just sitting below 107 here. And gold as well, bumping up again today, pushing up to monthly highs here, along with a nice little bump up for crude oil, seeming to defend the support zone once again. And so it's kind of a little hard as to what to make of crude here. We seemingly keep testing the support zone, which technically means it's getting weaker, but we do have bullish seasonality. Middle East tensions could still spill over. However, there is a big expectation they could also be resolved. And just looking at inflation expectations, kind of hovering around where they were before the election. Another good way to measure the market's inflation expectations, looking at the spread of commodities versus long-dated treasuries, just kind of bumping around as well. No clear direction for the here and now. And just finally today, Donald Trump is set to ring the New York Stock Exchange opening bell tomorrow. Interesting to see. That causes a bit of enthusiasm in the market off the open. And like many analysts are now saying, we could have both a Fed put and the Trump put, or the White House put. Just like in his first term, he watches the market every day and he wants to see it go higher. So he definitely doesn't want a big crash whilst he's president. Not to mention Jay Powell, guy worth over $100 million, him and his buddies at the country club. Are not just going to sit there and let their $100 million fortunes go down to $80 million without doing anything. So we've always got the Fed put there as well. But the best story for me today was being vindicated as a long-time Tesla bull and just seeing the long-time Tesla bears, hedge fund managers getting picked off one by one. It was kind of funny. It reminds me, I think this was going back 6-7 years now. David Einhorn constantly on CNBC trashing Tesla, saying he was short. Elon Musk famously sent him some Tesla shorts in the mail. And just like Bill Gates, who was also short the stock, it just gives him more motivation to work around the clock and make sure all these guys lose. Just like they have been for years. But unfortunately, like we see Jim Chanos, just can't seem to let it go. Stuck in his head. Anyway, I'm not complaining because it's most likely helped. Once again, a new squeeze to all-time highs. And almost like a prophecy playing out, after Elon said 6 years ago, I'm considering taking Tesla private at $420. Funding secured, but he didn't have to do that. The market did it for him today. That's all I got for you today. Thanks very much for tuning in, and I'll see you again tomorrow. Cheers.